All right, let's just jump right into this explainer. If you've been watching the markets closely through mid-2026, you've probably heard this growing chorus of skepticism surrounding the whole artificial intelligence boom. People are looking around asking, have we completely missed the boat? Is this the top? And honestly, it's a totally natural reaction when you see these staggering market caps and relentless headlines every single day. But today, we're going to pivot away from all that anxiety and look directly at what the actual data is telling us. We're going to systematically break down why this AI opportunity might actually be far larger and have way more runway than the skeptics realize.
Look, let's just address the elephant in the room right off the bat, okay? The sheer hype, the multi-trillion-dollar market caps, the frankly extraordinary returns already delivered by companies like NVIDIA, it is all historically significant. It's so easy to look at that chart and feel like the whole story has already been written. But the data tells a completely different story. We're actually transitioning out of this phase of speculative excitement and moving right into a data-driven reality check. We are literally still in the early innings of a multi-decade technological and economic transformation. And the kicker? It's backed by actual, real revenue and unprecedented capital expenditure.
So here's our roadmap for today. We'll cover 1. The current landscape, 2. The 3 phases of AI, 3. Key portfolio builders, 4. Macro tailwinds, and finally, 5. Risks and realities.
Let's start with Section 1, the current landscape, setting the stage in mid-2026.
Okay, I want to hit you with a massive number right out of the gate. $1 trillion. That is NVIDIA's estimated cumulative revenue potential just between their current Blackwell and upcoming Rubin architectures. CEO Jensen Huang has pointed to this figure himself, and honestly, it completely recontextualizes what we think of as big. We aren't just talking about selling a popular consumer gadget here, we're talking about an industrial-scale rollout of foundational compute infrastructure. The demand for these GPUs just continues to completely outstrip supply, driving this incredible revenue pipeline.
And right on the heels of that, look at this figure, $600 billion. This is the projected 2026 collective capital expenditure from the hyperscalers, so we're talking Microsoft, Amazon, Google, and Meta. Some estimates even push this closer to $750 billion when you factor in other players. This really firmly grounds the whole concept of hype into tangible, massive corporate spending. These tech giants are pouring unbelievable amounts of free cash flow into AI infrastructure, in what analysts are literally calling a generational transfer of wealth to chipmakers and infrastructure providers.
Now here is where we do a little yes but reality check. Yes, market caps are at multi-trillion levels. NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta, they absolutely dominate the indices. But let's look under the hood at the underlying fundamentals. The forward price to earnings, or PE ratios, for leaders like NVIDIA have actually compressed in recent analyses. They've dropped to levels we honestly haven't seen since 2019. So, despite the stock price going up, the earnings have grown so explosively that the company has actually traded below the S&P 500 average PE at times. The underlying growth is literally outrunning the stock price.
To put this in perspective, global AI spending is forecasted by Gartner to hit roughly $2.5 trillion in 2026. Within that massive number, the semiconductor industry is completely transforming. AI chips alone are approaching $500 billion in revenue. That is roughly half of all global chip sales. The entire semiconductor pie is definitely growing, but the AI slice? It's basically taking over the entire bakery.
Moving on to Section 2, the 3 phases of AI, moving beyond the picks and shovels.
To truly wrap our heads around the longevity of this trend, we've got to walk through these 3 distinct phases. Phase 1 is training and infrastructure. This is the picks and shovels phase we've been living through, right? Building the massive data centers required to train AI models. Then, phase 2 is inference and edge, where those trained models are actually deployed into daily production. And phase 3 is enterprise and industry transformation, where AI just fundamentally reshapes the broader economy. Right now, as we speak, we are really just transitioning from phase 1 into phase 2.
But hey, don't let that transition fool you into thinking phase 1 is anywhere near done. It's far from it. Extremely ambitious industry projections show that AI data center chip revenue could hit $1.2 trillion annually by 2028. That represents a nearly tenfold increase from earlier baselines. The build-out of this foundational infrastructure still has massive runway ahead of it.
So, let's define phase 2 inference. Inference is basically just the act of running a trained AI model to generate a response in the real world. Think about when you ask a chatbot a question, or when an AI analyzes a medical scan. That's inference. As models move out of the research lab and into millions of live production applications, this is where volume scales dramatically. Inference requires sustained, widespread demand for chips, networking, software, and power, far beyond those initial training clusters.
All right, Section 3. Key portfolio builders and ecosystem beneficiaries.
Let's break down the heavyweights here. In chips, NVIDIA maintains this dominant, wide-mode 80 to 90% market share in AI GPUs, though AMD is definitely pushing hard to gain ground. Then there's the foundry level. TSMC is the undisputed manufacturer behind all of it, projecting over 30% revenue growth driven by this insatiable demand for their advanced 3-nanometer nodes, which is the incredibly microscopic architecture making these chips so fast. Finally, you have the hyperscalers, Microsoft, Amazon, Alphabet, and Meta. They are the ultimate distributors. They combine cloud scale with massive data advantages, and their heavily diversified revenue streams provide fantastic ballast for a portfolio.
But it's not just the mega caps, right? Beyond them, there's this incredibly rich ecosystem of supporting players providing critical infrastructure. Broadcom is leading in custom ASICs, which are chips designed for highly specific tasks and networking. Meanwhile, Micron dominates the high bandwidth memory that is absolutely crucial for these AI chips. Palantir is a major frontrunner in enterprise AI software deployment. And then you have hardware and data center architecture specialists like Supermicro for servers and Arista for high-speed networking. These companies offer really diversified exposure to the entire AI stack.
Let's zoom out a bit for Section 4, Macro Tailwinds and Impacts, the bigger economic picture.
We've got to talk about this fascinating academic concept known as the productivity paradox. Right now, studies are showing incredible individual gains. Workers using generative AI are completing tasks anywhere from 12 to 40% faster, literally saving hours per week. But you often don't see that immediately reflected on the bottom line of the overall company. That's the paradox. Organizational lag is very real. It takes a lot of time for massive corporations to integrate these new tools, rewrite their workflows, and scale the technology securely. However, as that integration matures across industries, this paradox starts to resolve into massive economic impacts. Research from McKinsey estimates that generative AI could automate up to 60 or 70% of certain work activities over time. That translates to an estimated boost in U.S. productivity growth of 0.1 to 0.6% annually straight through the 2040s and beyond. We are talking about adding trillions of dollars annually to the global economy. This isn't just a tech story anymore, folks. It's a GDP story. Which brings us to our final section, Section 5, Risks and Realities. Time to ground the hype.
Look, no honest analysis ignores the risks, and there are definitely real headwinds. Start with high valuations, which means any slight slowdown in spending could severely pressure stock multiples. Add in intensifying competition, especially as these hyperscalers develop their own custom chips to reduce their reliance on NVIDIA. We also absolutely can't ignore geopolitics, particularly regarding Taiwan, where TSMC operates. That, alongside strict export restrictions, represents a persistent systemic risk. Furthermore, energy and power grid constraints are rapidly becoming a massive bottleneck for building new data centers. And finally, adoption hurdles. Enterprises are going to demand hard proof of return on investment, and they are currently battling a pretty severe skills gap.
But to keep our perspective totally balanced, we really have to look at history's lesson here. Previous technological revolutions, like the internet or the shift to cloud computing, absolutely had pauses and corrections along the way. That's normal. But they ultimately delivered massive, world-changing long-term value. The big difference with today's AI spending is that it's backed by real, tangible, explosive revenue growth right now, not just the distant promise of eyeballs or clicks sometime in the future.
So, we've unpacked the data, the phases, the players, and yes, the risks. The structural foundations being laid right now are honestly just staggering in their scale. So I'm going to leave you with this final thought to apply to your own research and strategy. When you look at the sheer volume of capital deployment and the multi-decade runway of enterprise adoption we've mapped out today, is AI just getting started, or have we reached peak hype? Keep digging into the data, stay relentlessly curious, and I'll catch you in the next explainer.